All right, yes. And by the way, if you do have any questions as well, then please do let me know regarding the previous video that we can go over that. Now, I wanted to go over something that we did not go over yet in this candle science video, because the candle science video was candle science part 1, because we will go over another candle science video as well. And it is quite important to understand what we are doing when we are respecting both a premium rate and also a discount rate at the same time. What that then leads to is overall consolidation price action. So for example, if we take a look at the current price action that we see on the dollar, we come into this 4-hour value gap, we have beautiful rejection right there, which again is that respect candle, right? So the next candle we can expect previous candle low to be targeted. Well, ideally we can target then this low right there. And we can see again how this lines up overall with the fair value gap. Trace back into it. It's beautiful candle sizes, and every candle right there tells you what the next candle wants to do. Then right here, we start sweeping this low a little bit because we respect that low. All right, not too crazy, because we create a 4-hour value gap right there as well. Again, that 4-hour value gap, we sting into it, we respect that as well. So we can continue lower off of that again. Then after that, we then start to respect these previous candle lows right here. And there's an underlying reason why we actually start to do this, which is not something we're going to go over well, anytime soon. That is not completely true, but it's not something we are going to go over just yet, because we have news. We have a big 3 news event tomorrow, which is already known, NFP on Friday, which is already known to cause some consolidations ahead of that time. So that is usually also reflected in the price action itself for candle signs, order flow, whatever it may be. So right here, when we start to respect premium rates like that, and also discount rates in the same area right there, that becomes extremely 50-50 price action, which 50-50 price action in itself is also a topic that we are going to cover as well. I wanted to show a few more examples here as well, which was EU. So again, not super relevant for me to talk about that right now, but I mentioned in the forecast as well that I do not necessarily want to get involved on anything US dollar related if we are trading it the day ahead of NFP. And what you'll see is you'll sort of see fake candle signs, you'll see fake order flow when we do not have that time supporting the ID. So what I mean by that is, for example, if we look at this candle right there, this is already a beautiful respect right there of the 4-hour fair value gap, continue 4-hour fair value and fair value gap right there to continue higher off of that, which eventually fills right there. So when that fills as well, I want to be very careful right here that I'm not trading consolidating price action, rangy price action right there. That is something we need to be aware of right here, that this is a perfect time to take a step back. Let me see, is the chart a bit blurred for anyone else? Like the quality is a bit worse than the previous live session. I can do something about that. I changed it now a little bit. Let me know if it did change as well. Perfect. All right. Definitely better. Perfect. All right. So that is very important to understand about candle signs right here. That it can also tell you exactly when we are consolidating, when we are respecting both premium and discount rates. Now, let's take a look at ES as well, the example I used in the video and what happened afterwards. Because I remember, not exactly, but I remember in the video that if this candle were to close above that previous candle high right there, then ideally, of course, what would be the next target? Again, this previous candle high right there. If we were to close above that right there, which did not happen. We had a huge sweep actually continuing lower right there. So what can be the next target? Well, on those next few candles, this can now be the target. Afterwards, what do we see? Do we respect that? I would argue not really. After that, we again see a sweep of this low right there, where the next target becomes quite clear, because now we have a swing high that we can then look to target. So that constant reacting, especially in those sort of consolidating areas right there, that is extremely important as well. Then I have one more example as well that I want to go over, which is GBP Canadian dollar. So this right here in the forecast, I mentioned we reached that target right there. Once we reach the target, we can see we are currently respecting that target. Now, this is also a funny thing. When we respect a premium array and we are coming back into a discount array where we expect potentially higher prices off of that, that usually leads to a bigger retracement in the same discount array. So how do we know if we will only have a sting into this fair value gap, or if we will continue a little bit lower, potentially come into the overlapping part, into the fair value area right there, to then continue higher off that? That's usually seen when we respect an opposite PD array. So in this case, a premium array right there is being respected. That overall leads to a lot of momentum coming into the discount array. So the way I want you to see this, if we have premium arrays and we also have discount arrays sitting right there, then once we have price action like this coming a little bit higher right there, and we start to respect that premium array, that means that there's some kind of bearish intention, there's some kind of bearish order flow establishing right there when coming into the discount array. So we might have a bigger retracement into the discount array to then continue higher. Whilst when we start to disrespect the premium array immediately and we then come in back into a discount array, we will likely only sting into the discount array. Simply said, because we have more bullish intention overall already in the market established. Which, if we look at this candle right here, then we also see a very late close or a very low close right there. The reason I started late close is usually when we close very low like that, we come into the discount array very late during that candle, meaning that we do not have time to expand higher anymore. We do not have the time to actually create a rejection, which is where the rejection is then created on the next candle. So right here, we come into this daily fair value gap, into the daily fair value area as well, and we have a low close right there. So we do not expand higher just yet. Perfect. Then the previous day low sweep right there can cause now the move higher right here. But this is where it gets interesting as well, because we also have a 4-hour fair value gap going against us right here. And when we look at this price action again, what do we see? We are respecting the previous day low. We're also respecting the 4-hour premium array sitting right there. This again is something we will dive into deeper as well on the conditions you would want to avoid. But that is extremely 50-50 price action right here. We're stuck between two PD arrays, stuck between a premium array and stuck between a discount array. We're respecting both sides right there. That is very 50-50 price action. You see, I assume the live video is currently going ahead at the moment. I'm using the work computer at the moment. It doesn't want to connect. Yes, we are going to move on. I'm not sure. I'm not sure if it is something I can change. Not too sure. But it is recorded as well. So this is sort of the last resort as well that we have. All right. So right here, ideally, what would you want to do in a scenario like this as well? Well, you want to wait for, this is something where we need to go over order flow as well, where we need fair value gaps actually to tell us what we want to do. But we want to wait for one rejection right here to get taken out. So either the rejection that we are currently seeing is getting taken out, this rejection higher right there, but ideally confirmed with some kind of order flow, with some kind of fair value gap higher as well or lower. So that is something we are going to touch on tomorrow, actually, in the next video. Now, if we take a look at a few other pairs right here, I hope Australian dollar, US dollar is the textbook example right here of a run on liquidity versus a sweep on liquidity. And I hope you can also see what I meant with sort of the dominoes effect. Because right here, the dominoes effect on Australian dollar, US dollar was that if we do not continue lower off of this 4-hour fair value gap lower right here, and we start to disrespect that right there, and we create that bullish ST, bullish sharp turn, we get a bullish fair value gap right there, then after this price action, after this 4-hour fair value gap, let's actually look at the daily. There are no fair value gaps, which also means if there are no fair value gaps, there are no order blocks, there are no breaker blocks, there is nothing holding price back from now all of a sudden reaching these highs right there. And that is exactly the area where price will also move fast. So no resistance runs, also known as low resistance liquidity runs, that is something we will go over. And that happens there when we only have swing highs right now holding price back from reaching those highs. That's when it happens extremely fast. And that's why we're seeing what we are seeing on the Australian dollar, US dollar as well. And that again creates the overall dominoes effect, where this premium rate starts to fill. After that, we do not really have a clear, or we do not really have a valid premium rate that we can continue lower from anymore. That is when we will do everything very, very extremely fast right here, moving higher. So we again, the run on liquidity can be seen right now that we are closing above those highs, not respecting them by any means. And that creates fair value areas as well. We can continue higher off of right there eventually. So this was what I wanted to go over right here. Well, actually one more. I wanted to go over silver as well. Because silver right here, we talked about this whole scenario right there. And afterwards, when we come back above that high right there, we see that we are sweeping that high, meaning we are sort of respecting that high right there. Now, this is also quite interesting because when we do start to respect it high, does not automatically mean that we will look to continue lower. If we now start to respect that high and we start to actually get a sweep is then confirmed by fair value gaps actually going lower. So not initially, this is the first sign, but overall we still have more bullish arguments supporting the idea as well. Now, if we pay more attention to a sweep actually being respected, if we pay more attention to a run or sweep on liquidity, then let's actually quickly go over the theory of a sweep on liquidity versus a run on liquidity before we dive into the next session. Then right here, when we sweep liquidity, what are we essentially doing? We are trapping people. So to visually give you an idea, this is breakout traders right there that might have their stop loss below recent lows right there, might target, who knows what they are targeting, but they might target something along the highs as well right there. Now, these are breakout traders. There are also people that might have gotten involved above those highs with sells, etc. But this is the example that will make it probably the most visually clear for people. That when we trade above that high and we try to trap traders in the form of this should be a sweep right there to then continue lower. So we are essentially trapping traders. That's all sweep is. Trapping traders, trapping some kind of liquidity. Now, it's not your average Joe again that we are trapping. It's purely financial institutions that actually have some big money in the game right there. So right here, when we look at this, then if we actually want to sweep that and we want to trap them, then would we not want to stay below that exact high right there? Because if we now stay below that, we are, as we can see, we are constantly in drawdown right there. In other words, we have no room anymore to get out. We can't mitigate the position. We can't get out anymore. So then as soon as we see a candle trading back above that high right there, that to me is always suspicious, because that indicates to me, and especially you'll hear me mention this quite often, when we get comfortable above a high. When we get comfortable above a high, that means that we have no urgency to sweep it. We are not sweeping it aggressively. That means we are getting comfortable above a high or below a low. For example, the difference between, and this indeed is a fair value gap, which can also be correlated to that swing low, of course. So are we comfortable below this low right here? Well, I would argue not really right there. So are we comfortable right there above that high? Well, there are a few signs right there that could make the argument that we are comfortable, but I would argue not really. It's quite similar to that price action right there. So when we then start to have wicks again continuing higher right there, that indicates to me that this is not a sweep. We never got a fair value gap lower. We are comfortable above that high right there. We're not trapping people, because if we want to trap people, we should immediately follow through. Same idea with this right here. If people are getting trapped right there, have their targets wherever they want them to be, then we should ideally not allow them to mitigate the position. It should ideally run to their stop loss. Why? Because that stop loss is someone else's take profit. So if we want to actually trap people, then we should suffocate their position, because otherwise we also don't have a take profit to actually deal with. So that is smaller the detail. All things we're going to go over later on as well in different videos, but that is also how candle signs can support that idea in general as well. Now, let me see if there are any questions on this particular topic on the candle signs. overall. And if not, then we will move on towards the next session. Let me see. On the candle science video, you were talking about the first candle rejects, second candle respects. What is the difference between the two situations? A second candle trades below the first candle low, but does not close below the previous low, and candle trades below the first candle low and close below the previous low. Below the first candle low. So the difference between that is, for example, if we have and do, I'm not sure if I fully understand your question, but do let me know if I understand the question. So right here, if the first candle is not a rejection, then the second candle can reject. So the first candle is not a rejection, second candle can reject right there, and it will use a new discount rate because these discount rates essentially have been sort of used up, meaning that we use the previous day low right there. So if this is now a close below that, then we can confidently say that we had the chance to reject on this next daily candle, but we did not take advantage of that. So if we do not reject on this candle, meaning if it's not an up candle, if we do not close below that low right there, then I would argue the next few candles are definitely down candles to actually continue lower, since we are again not having that rejection. So if this is a close below, then I would argue we are looking to target a new discount rate as well, if that makes sense. Hopefully that answers it a little bit as well. Let me see. If the first candle fails to expand, I can assume that price will go different direction. Depends on the overall scenario as well. If the first candle fails to expand, then we can still expect that candle to get taken out. For example, right here, this candle fails to expand higher, then we can expect the previous day low sweep right there. But then after that, if this candle fails to expand, then we can assume that we are moving into lower direction. Indeed. Can you show another example of suffocating a position? Yes, for sure. Let me see if we can find a few examples right here. Let's see. So usually what you'll see is actually go towards something like ES. For example, this right here. This position right there. Right there, if we wanted to move higher and we were sweeping that low right there, we can see again similar characteristics, that we are getting very comfortable with not moving higher essentially. If we were truly to suffocate this position right here, so meaning suffocate again, breakout traders right here want to get involved. So if we want to suffocate their position, we should now trap them essentially. That's the first step. Trap them. We should then move higher aggressively. What is a move higher aggressively? A sweep. But it's also seen through fair value gaps. So the whole reason why we use sweep right there, and again, defining a sweep, that candle respect, then a fair value gap actually going higher to then target the opposing liquidity right there. In other words, just a sharp turn right there to then target the opposing liquidity, is because we can then confidently say that we are actually trapping people. Where right here, I would argue we are not trapping people because we are again sort of getting comfortable in their price action. We are allowing people to potentially get out their position. We want to do everything extremely fast right there, which to us is again the high probability conditions as well, which is seen here, which then it happens fast right there, targeting the opposing liquidity. And the same happens on Australian dollar, US dollar, which is the perfect example right here. When we have breakout trades below those lows and their stop loss might be at the opposing liquidity right there, targeting whatever they may be targeting. And then afterwards, what do we see? We see a sweep right there, happens aggressively. We start to get a bullish value gap right there. Perfect. Start to respect that bullish value gap right there, indicating, all right, we are indeed sweeping this right there. We are indeed trapping people to then target their opposing liquidity right there, which could be our take profit, for example. So that is how we trap those traders constantly, if that makes sense. And the whole ID right here between a sharp turn, between a sweep, is based on essentially this, if that makes sense. What does it mean when price keeps giving you wicks in a fair value gap? That's a great question as well. And let me see if we can find a certain example. So this oftentimes is not a great thing to see. And what I mean by that is if price keeps wicking the same fair value gap, then usually the fair value gap itself is just not that strong. And let's see if we can find an example. By the way, really quick, euro US dollar, we now have a huge expansion actually right there. It's actually still on the lower time frame. What are we doing? It's quite interesting overall. Quite interesting. Now, if we look at a certain fair value gap that keeps on wicking over and over and over. For example, this is not necessarily a wick, but we do have this 4-hour value gap right there that constantly comes back into it. We actually have the same example on crude oil a few weeks ago right here. For example, this weekly value gap keeps on wicking it. It's the same premise, as in the first candle here can be a rejection, which is essentially what we're seeing. So that previous candle high sweep right there is already a little bit, all right, that's pretty odd, but it's not too crazy because we still have a bearish candle right there, a down candle. So we can just look to follow through. Now, after this, the objective of price action coming into a previous fair value gap, which is what we're going to go over in order flow as well. The objective of price action right now is to create a new fair value gap as soon as humanly possible. And what I mean by that is sometimes the candles might be a little bit in the way. We might have a long wick, so it takes a few more moments to create a bearish fair value gap again, a new bearish fair value gap. But right here, there is nothing holding price back. We need to expand below this low right there to create a new bearish fair value gap, to create an expansion candle at least of a new bearish weekly fair value gap. So right here, if that does not happen, then that's a great sign right there. Whilst it's forming, actually, it's a great sign. And then this happens. That is already the moment when you want to stop looking at this. This is extremely low probability, which in turn then leads to that this weekly fair value gap right there is already lower probability. And it's the same for the GU example that we had. Let me see. Right here. At this moment in time, perfect. This is perfect. This is the perfect 2-candle rejection right there. But after the 2-candle rejection, now order flow comes into play. Because now we need to actually create a new fair value gap. And if we do not do that right there, and we have this up candle, boom, that's it. That 4-hour value gap is low probability, which then leads to overall dominoes effect. Because now we can all of a sudden start to target these highs. We can all of a sudden start to target these highs right there. Same exact premise. Let me know if that makes sense. If we have an inside bar / candle in an order flow lag, then how would you determine if it is disrespecting, assuming that it is sweeps both the high and low? That's a good question. And if I understood that correctly, then it really depends overall on the fair value gap that we still have. If that, for example, is the third candle of a fair value gap potentially being created, then we can still simply trade back into overall that fair value gap, because order flow is still the idea of following through in that direction. So it's also something we need to go over with order flow, because whatever order flow will do, whatever the fair value gap is telling us right there, we have a fair value gap still going into that direction, then the inside bar candle is not super relevant. We can still determine that we just continue in that overall direction. Now, let's say if we do not have order flow and we are just simply having that inside bar, etc., having that inside candle overall, and we're not really having a clear indication of that we are respecting one side and disrespecting one side, that again leads to overall 50-50 price action. So that is very similar to for example, the dollar example we wanted to go over right here, where if this candle were to close like this, with the previous candle low right there being respected, previous candle high right there being respected, already came into the fair value gap, that then leads to overall very 50-50 price action. If that makes sense. It makes so sense to me. Perfect. Love to hear it. So where the second candle close above / below the previous low is more important than the wick range, second candle low, first candle low. So where the second candle closes above / below the previous low is more important than the wick range, second candle low versus first. Not entirely sure what that means if I can't visually see it. But if the second candle close below is more important than the wick range, yes, that is. If I look at the question right there, then I would argue yes, that is more important, because the second candle will tell us a lot right there. If it closes below or above previous low or high, then that indicates that we do not actually respect it, if that makes sense. If it helps, then you can also send me a visual representation of the question later on a little bit, and I'll go over it as well. When it comes to sweeping a high or low or previous X candle, is there a way on the lower? Is there a way on the lower time frame to see if it's sweeping or running it in moment? Would this be in the case of the relative time theory? As you were coming towards a previous day high, we can identify this. Yes. Yeah, it makes a lot of sense, actually, your question. And that's actually the next topic as well. So, because, of course, ideally, when we go over candle signs right here, we are going over it after the fact. And what I mean by that is I am not necessarily waiting for this 4-hour candle close right there to then get involved. We already want to get involved right there whilst this is forming. So how can we now view that this candle, or how can we now confidently say that this candle will close like that by looking at the lower time frame? And yes, that is exactly what we're going to go over as well. And what we want to do then is indeed that time theory where we go into the lower time frame, and then we need to look at order flow on the lower time frame. So next video will help a lot with that, where we go into, for example, in this case, you would go into the 5-minute, the 15-minute to look at a sharp turn lower, to look at order flow being established lower right there, which eventually leads to the understanding that this candle will close like that. So then we can get earlier signs that that candle actually will close like that, if that makes sense. Let me see. Last question might be a bit ahead in regards to the ST. It still relates, I believe, with the ST. Disrespect of the incoming fair value gap before creating a fair value gap to form is a disrespect of the incoming fair value gap used by candle signs. Yes, ideally, yes. Yes, exactly. So when we have a sharp turn, and let's see if we can find an example. Well, this is a good one right here. When we have a sharp turn, what we usually see is, or what we can see, not always, is that we might have a rejection right there of the first incoming fair value gap right there. And afterwards, we create a new fair value gap. So this, based on candle signs right here, is already what we can then see that we are disrespecting that incoming fair value gap. So that also makes this new fair value gap a little bit higher probability. Where again, if we're looking at candle signs, we can potentially even get involved as soon as we take out this low right there, and as soon as the rejection fails overall. But that is a little bit more advanced. So you only need 2 candles to know if the... Wait, sorry, Chris, I missed your question. We'll go over it. Let me see. So you only need 2 candles to know if the fair value gap is being invalidated. If so, could you use this candle sign in the lower time frame in order to manage your trade? Yes, exactly. And I'll show you an example right here, which I did not show it in the video because I don't know, I didn't want to go over this example in the exact video. It might have been too confusing, etc. But right here, in this lag higher, let's study where we can still continue higher from. And at this moment in time, we can get extremely accurate with our risk management, with our stop loss as well. So right here, we can still continue higher from. Overall, we have these fair value areas right there. And then the sort of the last line that we can continue higher from right there is that high right there, which is essentially just your breaker block right there, which we can continue higher from. So when we then look at this right here, and we look at this rejection, then what are we seeing? We are already seeing a rejection. First candle respect, second candle right now should also just continuing higher. So right here, what are we doing? Well, we can, if we were to get extremely advanced, this in itself could already be an entry, and this in itself could already be your stop loss. Let's say you got involved a little bit earlier right here, and you first were looking to cover this low, then in real time right now, what can you do? You can replace your stop loss right there towards that low right there. And eventually, right there, continue higher. And you can continue doing this for every single one of these things, where now the stop loss can become this low right there. And that is, for example, if we have conditions that we are not too certain of, and we do not trust the conditions fully, then this is great risk management, because right here, you're just being very strict with your risk management right here, but still based on actual logic. So this can, of course, lead to entries, can, of course, lead to great risk management, can lead to a lot of different factors, can lead to a whole trading plan. It's also something we're going to go over eventually. trading Nasdaq futures, I'm noticing the challenge is stop loss placement is something that takes a little getting used to. Yeah, definitely. It's yeah, it's almost like a skill on its own, to be honest. It's quite important. How are you tackling that challenge? Thanks in advance. I found minis help me achieve my 5% risk and not having such a tight stop. Especially if you're just starting out. Before I talk about my challenge, especially if you're just starting out, then having a tight stop is also usually holding people back. Eventually, we can refine that stop loss as well and make it more tighter, more refined eventually. But at the beginning, you just want to focus on: do I have a clear draw on liquidity? Can I not suffocate my stop loss right here? And ideally just let it run. My challenge, by the way, this week has been, honestly, has been really good for me. I'm up 10k on the 300k account. So ever since the last live session as well, I've been trading actually the 300k account instead of the 100k account, because yeah, the biggest account size. Why would I not trade it essentially? I'm up 10k, up 10k. So that is, I believe, that's half of the challenge, But I'll knock on wood, won't jinx myself to then blow the account, but I'll try my best. But so far it's going good. Let me see. How do we factor candle signs in when entering on the 15-minute, for example? Because I've often seen price disrespect the fair value gap, which I'm entering on, and then afterwards hit take profit. So, well, when we are entering, it's always a little bit more tricky. And what I mean by that, when entering it, there's a whole thought process on why I personally always am a little bit more loose with the entries. And the reason for that is because if we start to pay attention to everything needs to be picture perfect in our entries, we oftentimes forget the whole reason why we even got involved in the first place. So if I were to get involved right here and I would need the absolute perfect price action coming off of this fair value high right there, then I'm ignoring the fact essentially that the higher time frame 4 hour fair value gap might be following through here, which is a lot stronger than whatever the 1 minute is doing right there. Will the 1 minute show early signs? Yes. But if you're looking at an entry, then I would advise as well, be a little bit more loose with the rules. Not too loose, of course, but be a little bit more loose, because oftentimes during that entry, we forget the reason why we got involved in the first place, which was based on something on the higher time frame instead of the 15-minute alone, right? So if the entry was purely on the 15-minute alone, or you're using the 15-minute PD array, then it would be a different story. But if it's a 15-minute entry, then I would say, all right, be a little bit more loose with that as well, if that makes sense. Let's see. Can you do an analysis on Bitcoin for our ST? Yes, I will go over that in a little bit. If we don't have any questions anymore coming in, then I will end this and the spring enrollment session right here. We'll move over to a little bit more of the advanced section as well. All right. Let me see. I will end this one right here. Perfect. Thank you.